What up, y'all? What up, y'all? What up, y'all? I'm gonna guess the sound is good. It says minus 3.9 dB here. All right. Let's get into the investment stream. Sound is good. Sound is good. Sounds good. So, the first thing you will notice, this is my FinViz. So you go to create new account, and in my presets, I got return on equity depth, 20-day moving average crossover, fundamental wedge down, day trading, swing trading, strong wedge down. So these were my technicals: wedges, moving average crossover, more wedges, and day trading. Every day before the start of the session, I would open up my day trading, and these are the metrics I have saved. And as you can see, for today, there is today Monday. Today is Monday, a work day. Stock market's open. There are 3 companies available to day trade. And if you go gap, that's up 2%, and you go gap down 2%, there are 2 companies to day trade. So that's the day trading, and if you want to save it, you can go screen options, save changes, alright? But I don't do day trading anymore. I do swing trading. So swing trading, long-term debt to equity under 0.5. Basically nothing here except for sales growth past 5 years, 15%. Earnings growth this year, 30%. And that gives me 237 stocks. So that's why I can filter out individual stocks. All I do is sales and earnings. And then over here, I sort by, let's go return on invested capital. Whoa. Other way. And I can see Nvidia is the number one. Look at these 170, 80, 100% returns. Look at that volume, 40 billion or 40 million. Oh, it is worth 5 trillion. Oh, this is Canadian dollars. 5 trillion. You got Taiwan Semiconductor worth 2 trillion. Google worth 4 trillion. Biopharma worth 1 trillion, and some Chinese companies. And you see their rates of returns over here. So one thing you just look for, like this is just a $1 billion company. You're not going to pick this. And if you hover over it, you can see the graph image. So this looks like a good graph. Super Group, but it's only $7 billion. It's got a 2%. I like this Super Group. Why? Because they're trustworthy. They pay a 2% dividend. Small company, $7 billion. Great returns. I'm gonna Super Group. What else we got here? See, like this stock price went up and then it went down, and this is the yearly stock price, yearly date. Comfort Systems. Trying to look for a good chart. Everything went up and then it went down. Nvidia's got a good chart. Super Group. But you only got to find one good company. So Super Group is looking good. So then I go into my stock chart. Open list. And I simply add Super Group. Here it is. Super Group. Became public in 2021 at $10 a share. Fell to around $4 a share. And now it's up to $15 a share. Volume heavily picked up in 2025 of last year. 2025 of last year was at $8, $10, and now it's at $15. So it went up 50% since last year. And margin has increased, revenue has increased, and net income has increased. Quarterly, it's also increasing quarterly. The technicals are a strong buy. The analyst rating is a strong buy. I would definitely buy this company. Super Group. They are casinos and gaming. Only 30 PE, 1% dividend, 2 billion revenue, 217 net income. Super Group is a global digital gaming company. So digital gaming company which engages in global online sports betting and gaming business. Betway, a premier online sports betting brand. And Spin, a multi-brand online casino offering. Betway, Spin, Betway and Spin. It's headquartered in England. Founded in 2020. So it's only founded in 2020 and has a lot of success. Beating expectations. Oh no, falling just short. I don't know. So this is something you can sprinkle a little dough in. That being said, let's go over the broad investing thesis. I use my little FinViz to screen swing trading, and all I'm doing is screening for 30% earnings growth this year and 15% sales growth the past 5 years, with debt to equity under 0.5. And then that gave me 237 stocks out of the 10,000 in the stock market. 5,000 in the stock market, I'm not sure. So out of these 237, I sorted by returns. Return on invested capital. Nvidia was the top, and then I looked at the market capitalization, which is the size of the company. The ones that give a dividend are kind of more trustworthy. And then I hovered over them and look at the stock price, the stock chart. Other than that, what do I do? So one thing I look at is, oh wait a minute, the macro environment of the stock market. So you have, this is the S&P 500. There was a little dip in March, April, and another dip in March, April of last year. Other than that, it is in a bull run. In the Nasdaq's a little more turbulent. It's gone down since August of last year. I don't know why that is. But the S&P 500, which is why it's always a safer bet, because it's less volatile, is doing well. So if we invested in SPY, we would have made at least 15% since last year. And if we invested in the Nasdaq and the QQQ, where's the QQQ? QQQ, we would have made, since last year, also another 10-15%. So that's the general strategies. You want to be investing in SPY and QQQ, which is your indices of your Nasdaq and your S&P 500. And if you want to, like, if you look at the medium cap, nothing happens. Look, this is the mid cap, nothing happens. And this is the small cap. Maybe small cap, some shit happens, but mid cap, nothing's happening. Bond market, nothing's happening in the bond market. So you want to be investing in your QQQ, your leveraged QQQ, which is the TQQQ, your leveraged SPY, which is the SSO. If you want to get really risky, the UPRO, really volatility. So So your small cap and your indices, that's about it. No bonds. And then your regular stocks. You got your watch list of your biggest guys: Nvidia, Disney, Apple, Microsoft, Google, Meta, Netflix, Tesla, Amazon, Uber, Blackstone, and the supergroup. So since last year, Nvidia still went up another 25%. 33%. 33%. So what my investment portfolio would look like would be say a little bit of SPY, a little bit of QQQ, a little bit of leverage, maybe a little bit of SPY, a little bit of QQQ, and a little bit of IJR. So a little bit of NASDAQ, a little bit of S&P 500, a little bit of small cap, and then I would go with my risky moves: Supergroup, Nvidia, and then to diversify, I would go back to my screener and go into, is it Maps? Maps. And I would go 3-month performance. Technology, Apple did really well. 3 months, Apple went up 20%, Nvidia went up 10%, Google went up 12%. Entertainment, Netflix went down 27%. Consumer cyclical stayed neutral, Tesla went up 13%. So these are your retail shit. Amazon stayed pretty much neutral. Healthcare did pretty well, except for the medical devices. But your pharmacies did really well. Energy went down. Defense went down. Real estate went down. Utilities went down. Financial went up a bit. So the biggest boom for the past 3 months has been technology, pharmaceuticals. Now I don't add any financials like Visa, MasterCard. Here it shows that Morgan Stanley went up 23%. Same reason I don't, sometimes I add some oil for energy. I guess the most ethical thing I can do is add a financial ETF. So an ETF of the financials and healthcare, it looks like United Health Group went up 40% and Lilly went up 26%. So once again, maybe an ETF for the healthcare and financials. And then we're going to take a look at Apple. So this is a 3-month heat map. So let's look at financial sector ETF. XLF. So let's add that. So let's take a look at XLF. Does it really cost $43,000 per share? That's just not fair. You're gonna need 40, so you're gonna have to do a partial share of this. But the performance since last year, June, July, it also went up 30%. So this is very good. Financial ETF went up 30%. You also got the Vanguard. And the iShares. So let's go with VFH. Now it comes up. Okay, so this is the Vanguard financials. Went up another 10%. The XLF is much better performing. Oh no, only that. I don't know what that one was, but okay. So this is your financial sector ETF. Goes up 10% a year. So that's a little diversification. Now, how is the history of it? The biggest drop, this seems, was in the COVID years, and it went down from 100 to set. It went down 20% was the biggest drop. It also went down 70 to 40. But since 2014, let's see. Since 2021, it went up almost double. So this is a pretty medium risky stock. Your Vanguard and your XLF is pretty much identical to it. And what's your IYF? Yeah, so these financial sectors, since I don't invest in Visa, Morgan Stanley, MasterCard, Goldman Sachs, I'm not going to, in Bank of America, I'm not going to invest in a specific bank. So the best thing I'm going to do is invest in the ETF, and you still get pretty good results. Since 2024, it went up like 60%. So it went up 60% since 2024. 2 years, 60%, or 80%. That's still pretty decent. Now we're going to look at the healthcare sector ETFs. So we have HHL and once again the Vanguard VHT. Let's just go with the Vanguard VHT and HHL. see what HHL is. That's in Toronto. Why is it bugging out? I literally clicked it. Oh, I reached my limit. So gotta remove some stuff. Alright, let me remove some stuff. Let me remove this. Let me remove this. Remove this. I got Berkshire Hathaway. Alright, now let me add. And BHT. Because I'm on the free plan. Which is enough. So your healthcare fund, since 2024, it went up about 25%. So your healthcare fund is a little bit more conservative than the financial fund. And would not recommend this Toronto version. I don't know what this is, bro. 10% dividend. So you got your Vanguard Healthcare. So there. Now I got my Jets. So these are my airlines. Airlines I buy when they get depressed. So as you can see, when the airlines, it's at 30, airlines goes down to 12, right? So airlines goes down to 12, and then it recovers in 2 years, 1.5 years. It goes back. It goes. You got 100% your money. So when airlines goes down, like here, it went down to 17, and next year it's at 27. So almost 34 by this year. So 2 years, 100%. So 1 to 2 years later, you will get 100% of your money by buying the airlines ETF. That's what I did when it goes down. Then we got our financial ETF, healthcare ETF. And if we look at our screener again, how is energy? Energy is down. Now, energy in the past, I used to invest in a specific company, smaller companies that do oil or whatever. But I guess energy ETF would be just as fine as well. So, energy, which is XLE and VDE. XLE and VDE. So the Vanguard version always performs similar to the regular version. Always, like, they're basically identical. What's the volume? And the Vanguard version, no. So, but the regular version has more volume. So the regular version has more volume, and the Vanguard version is identical. So what's the return of the energy ETF? It's the lowest performing. If you go back history, and it can really crash. I would not recommend the energy ETF. Do not buy energy. You gotta buy specific energy stocks. So if I look at just oil, oil futures. One company that I liked was Fang, which is Diamondback Energy. Here it is, Fang. This was a company I made a lot of money off of. As you can see, is pretty good stock. Started off in 2013 at $15 a share. 2020, $85 a share. Today, $188 a share. So my little energy stock is Fang, which has a 50 billion capitalization, and they are what's about them? Oil and natural gas company which engages in the acquisition, development, and exploration of unconventional onshore and natural gas reserves, operating in Texas. So headquartered in Midland, Texas. And I also got Valero, which is like ethical, right? So it's renewable diesel. So I got Valero, which is very So if you want, you can copy my list right here. This is pretty much an excellent list. I have the NASDAQ and the S&P 500, followed by the SPY, SSO, IJR, MVV, QQQ, and TQQ. So these are all your indices you will need, followed by the actual markets. The bond market. At the bottom I have my other ETFs, which include airlines, energy, financials. I would not recommend energy. And then I got my energy stocks right here, Valero and Diamondback. I got my one pick that I found today, Supergroup, which is my small company. What was it, $7 billion, right? $7 billion small company. And then I got my Berkshire Hathaway, Blackstone, Uber, Amazon, Netflix, Disney, Tesla, Meta, Microsoft, Google, Apple, Nvidia. Those are my big stocks that I watch. And this is Google and Apple. So to sum it up, for an investment strategy, you would need to buy into the indices. you will need to sprinkle in a little extra financial, healthcare, airlines ETF with some energy. And then you would have to go a couple of stocks, which we found was this super group, and some Nvidia is a good one, Apple is a good one, Google is a good one, Microsoft not so much, Meta medium, Tesla medium, Disney and Netflix are at discounts, Amazon medium, Uber discount, Blackstone discount, Berkshire Hathaway medium. That's my list and my strategy. So I can close this. So I got my maps and I got my screener. Once again, in my screener, it is swing trading, which is earnings 30% growth this year, sales growth 15% past 5 years, long-term debt to equity under 0.5. So sales, earnings, and debt. That's the screener. And then I sort by return. And then I hover over the chart. And so this was my let me make another So I got my big indices, then I got my SPY, QQQ, IJR, leverage ETFs, then I got my airlines, healthcare, financial ETFs, then I got my energy, Diamondback, Valero, and then I got my stocks, Nvidia, Apple, Google, Microsoft, Tesla, Amazon, Meta, Uber, Netflix, Disney, Blackstone, and Berkshire. Plus screener super group casino. And that's it really. Oh, I also got my bond. I'm gonna add commodities onto here. Just so you can track the cycle, because the economy goes stocks, bonds, commodities in a cycle. It goes commodities are good, then stocks are good, then bonds are good. So that's how you can track it. And here we had hype, That's all there really is to it. Other than that, my theory from 2025 was once again the screener and the heat maps. All my metrics, look at the financial statements and the money. The watch list, the technical analysis, the portfolio rebalancing, the index funds. And this is an example of Warren Buffett's holdings. Let me just italic this. Boom. Hold rebalance. And sectors. So example of hot sectors were COVID, technology like electric cars, AI, electric cars, power, or marijuana when it was legalized, and gaming. Those are examples of hot sectors. Warren Buffett's top 5 stocks in 2024 November, 2 years ago, were Coca-Cola, American Express, Chevron Oil, Apple, and Bank of America. Coca-Cola, American Express, Chevron, Apple, and Bank of America. And mine are the indices, sometimes airlines, healthcare, or financial ETFs, Energy, Diamondback, and Valero. And my big stocks: Nvidia, Apple, Google, Microsoft, Tesla, Amazon, Meta, Uber, Netflix, Disney, Blackstone, Berkshire Hathaway, which is him, and Supergroup Casino. That's what I got. Now you know my investment portfolio. My history using kind of this same method. So I was investing into the indices, and I was investing into maybe like a little bit. I wanted to do Bitcoin as well, but I there was no Bitcoin ETF at the time. So can we do a Bitcoin ETF? Let me see. Remove something. Let's move TQQQ. So there. Now there is a beat. If you buy BTC, literally the symbol BTC, which is also the symbol for Bitcoin, you can get it on the New York Stock Exchange as a trust. It's worth it's only got $3.5 billion of investments, but it basically tracks Bitcoin. So now is yet again a good time to buy Bitcoin because it is at a low price. Now is an excellent time to buy Bitcoin. The biggest was October of last year. 1 year ago, it was at 170,000 or 150,000, and today is at 90,000. So it dropped almost 50%. Now is an excellent time to buy Bitcoin. Although it is stabilizing, now is a great time to buy Bitcoin. So I can add that to the portfolio as well. So like I said, when I made $14,000 off a $20,000 account in 2 years. I was buying the indices, and I bought a little bit of Nvidia, a little bit of airlines ETF. I would have bought a little bit of the Bitcoin Trust. I bought some individual stocks. I bought this Diamondback Energy, and maybe I bought Nvidia. Could have bought some Apple, Google, Microsoft, any of these big stocks. I have it right here. Account was $20,000. I made $12,000, but I withdrew it all. So I had my indices, I had some bond, I had some airlines, I had Disney and Nvidia, and that was it. So I had airlines, bonds, Disney, Nvidia, and my indices, my leverage indices of this S&P 500, the QQQ Nasdaq, and I had SPY as well, the S&P 500, and that made me $12,000 in 2 years on a $20,000 investment. So there we have it. That is my complete investing guide. That's all you need to know about my investing thesis that I've been building up since 2017, so 10 years. I have this little document on the knowledge behind it. And I use TradingView free version for the charts and FinViz free screener. And then some news on my little this little app tells you the news when you click on the stock symbol. So you click on the stock symbol and it tells you news, and that is useful for the indices as well. And that's it. That's my complete investing thesis. Like I said, the earlier work that I was posting on was the knowledge behind financial literacy. So earnings, income, revenue, sales, cash flow, valuation ratios, balance sheet, income statement, rate of returns, and some technical analysis, as well as portfolio management. So let me just add that into here. Earlier works. Earlier works was simply financial literacy, revenue, earnings, valuation ratios, price, returns, cash flow, debt, as well as portfolio management and technical assist. That was basically, whoops. Oh, and investment theory. Investment theory, buying dips and trimming profits. So this stuff you also need to know. You also need to know investment theory, technical analysis, portfolio management, and financial literacy. And that's about it. Let me italic this. That sums up a general fundamental understanding of investing into the public stock market. You got some bonds, you got some futures, you got some commodities as well. You got some cryptocurrency. But that's the public investing market for everyday retail investors. What the big guys do is they invest privately, so they have access to private meetings with private companies and private funds. That's called private equity. But the hedge funds do this publicly. So if you invest your money with a hedge fund and not privately, they will follow this strategy. This is the public method hedge fund strategy. And the private method is private equity, where they invest into, get big funds that last 10 years and invest into private funds. That's my stock. What do I have here? Let me get this little. Let me get this and this. Let me put them there. Alright, what about that? Now I got investment pitch and investment theory. So like I said, you should be able to get this watch list, this heat map 3 months, this screener, and these documents about the theories. And that's public investing. Let me rename this to stocks. Stocks public sector. So this is now stocks public sector. And this is still Splendid Stocks. Alright, so that's complete. Everything, like I didn't go over the earlier stuff, which was the financial literacy mainly, portfolio management, technical analysis, and investment theory. Let me number this. So good luck. Like I said, you gotta invest the hype. You gotta go for big returns. You gotta get some safety and security with the index funds, and you gotta add some volatility and hype with some cyclicals like the airlines ETF, the energy, the Bitcoin, and your diversification with your healthcare and your financials. And your big stocks, Nvidia, the hype stocks, AI, electric vehicles, and like whatever big stocks kind of at a discount or whatever big stock is performing really well. And you do that with portfolio management, trimming profits. All right? Stay classy, kick it 1, 2, and peace out. Yeah.